Hello and welcome to the macro of it for the end of the week. It started on the 4th of September 2017, and what a week it has been. I did talk to you about this at the start of the week around the fact that there's all these central bank meetings going on. They've been huge, and I'll get to them as well. There's also been quite a lot of data in this country that's gone around. So let's start with that and let's have a look at the data in terms of what happened. So we had retail sales, we had the trade balance, we had the current account balance, and then the GDP figure that came out on Wednesday. GDP had a bit for everybody in terms of those that really want to be pessimistic and those that want to be optimistic around our economy. And I can understand why. If you look quarter on quarter, realistically, if we didn't have government spending, we would have seen a fairly reasonable contraction there. And that's not surprising. We did see a fairly reasonable move in the backside of things like commodity prices in the second quarter. We did also see a bit of a contraction also in price and consumption. So without the government spending quarter on quarter, it would have been fairly poor. But year on year, we are growing, and that needs to be part of it. And it was better than the quarter before. So that also needs to be put into it. I also want to sort of allude to the idea that you can see leading into Q3 that things will probably come from private expenditure, and you'll also likely to see it coming in net exports, really gapping up on the softer Q2. Q3 will be much stronger. So that's where that pessimistic, optimistic thing comes about. Retail sales, I think that also needs to be highlighted that it is really, really anemic. And that's on the back that, again, inside those GDP figures, the one part pessimists love pointing out is the fact that you did see household savings falling off a cliff. And I'll certainly put the chart up to show you how bad it really looks on that idea. So that was one part of it. Trade balance came out. It was relatively okay. It was down. The Aussie dollar was actually up in July. So despite the fact that we saw better commodity prices in US dollars, it was offset by that headwind of the Aussie increasing, and volumes just couldn't gap up on it. So it did miss expectations. $756 million surplus, which isn't bad, but it was well below what was forecasted. So moving to the other parts of it and moving to the monetary policy side, we did have the RBA on Tuesday. I didn't really mention it because nothing really happened. There's a few tweaks here and there, but in the main, they're pretty happy. Things look relatively rosy from a business side. Things are returning in terms of an economic side, and that's what we saw this week. So they're out of it. What did surprise is that the bank that did move rates was not the one forecast, and the one that didn't move on rates is the one that was probably likely to. So let's have a look at the Canadians. And the reason I want to look at the BOC, they are always compared as our most nearest developed nation economy. Understandable, they're very much exposed to things like commodities. They have very much the idea of a very similar setup in their housing scenario and their debt levels as well. What I would say is there is a fairly reasonable difference between their cash rates. So they raised rates that wasn't forecasted. There was only expected to be about an 18% chance of a 25 basis point rate rise at the BBOC. But they did raise rates. So they're now at 1% on the cash rate. That compares to us at 1.5. The other thing is they have exactly the same scenario we do. Income to debt is really, really high. It's not as high as ours, but it's not far away at 175% of debt to income. That's a huge ratio. Ours is sitting at about 180 to 190, depending on which metric you want to look at. They also have a higher amount of people under stress than we do. So if they were to raise rates further, it would really put Canadian households under real pressure and possibly even push some of them to the wall. So a lot of people believe this is them done. They're out of the market, so the BBOC is out. But it does give you that idea that they saw inflation returning, commodity prices going in the right direction, and explains why the Aussie dollar this week has been really quite positive. It is the idea that the RBA could actually sort of catch the market off guard and raise rates. You know my opinion, and I'm still very strong on it. They are not going to move rates to, at the earliest, in my opinion, midway through next year. And even then, it's really hard to argue that they could do it. Inflation is still the key here. Wages aren't moving. So I'd really sort of, again, reiterate my personal point of view. That is, at the moment, I can't see the RBA moving rates in either direction for the foreseeable future, and I'm talking 12 months. So it's an interesting scenario and an interesting comparison. The other one I want to get to is the ECB very quickly. They're the ones that I actually thought might surprise the market. They didn't. Mario Draghi is very conservative and continues to be so. He is plotting a very linear path to what he's going to do. So he actually alluded to the fact that in October, they will move on tapering their current balance sheet, and therefore also in December, they're likely to start tweaking their rates. It's probably down to the fact that the euro has been relatively strong. It's sitting at around about 118. It's been as high as 120. And that sort of pushed down the Eurozone's inflation issues. But in saying that, there's no doubt he's going to have to really move away from what is one of the most highly unconventional monetary policies on the planet, the Bank of Japan being the other. He's got negative deposit rates. He's got a scenario where lending is basically at zero. So he does start to have to tidy that up. But in the main, it's very much told to you, so the market can price it in. So no surprise from him. There was a surprise from the Bank of Canada. And what a week it's been. So leading into the next couple of weeks, it's going to get even more interesting because the Fed is coming up on the 21st. But I'll talk to you about that on Monday.
InvestSMART now offers a life insurance comparison service. All you need to do is answer a few questions, select your cover, and compare the results. This quick and easy service provides quotes with up to 9 of Australia's leading insurance providers. You can compare the benefits of each insurer with our easy-to-use comparison feature. We have a team of qualified specialists who can answer any questions you have and make the application process as smooth as possible. Just visit our website or give us a call.